This lesson is going to cover the Wyckoff terminology. So when you see the schematics, when you go through the Wyckoff lessons, you're going to be bombarded with a bunch of letters that seem like they make no sense. So what I want to do is bring a little bit of sense to them so that you don't get confused. Right? These will all make more sense as you go through and as you see them on the charts. And if it's confusing to you at the start, don't worry. Everything's confusing at the beginning. It will get easier over time. You will start to notice the themes among them and what the things mean. Right? So this exact sheet that you can see on the screen, this is shared with you, so you can have it, you can download it, you can print it off, whatever. So I'm not going to go through everything all at once, but I'm going to cover the key points of both accumulation and distribution. So in accumulation, you have some key levels. One of them is the creek. So that is the initial resistance level created by the automatic rally. Basically what the creek is your range high of your accumulation zone. So later on, when it breaks out to go higher, crossing the creek, or jumping the creek as it's known in Wyckoff theory, is a very important event. We also have a shift of control. So shift of control is the most important part of the entire thing. There are two of them, the first of which is in phase A, and that's when control of the market moves from bulls or bears, i.e. trending, to neutral, which is ranging. The second shift of control occurs when phase C moves into phase D and you confirmed a trend through the range. So I've talked about this in other lessons, but I'll repeat it again because it's extremely important and it's a mistake a lot of new traders make. Markets do not go from bullish to bearish or from bearish to bullish. They go from bullish to ranging to bearish, or from bearish to ranging to bullish, or of course, they could go from bullish, ranging, and continue bullish. The key point is the market will stop and go sideways after a trend before it trends in another direction. That is where the shift of control is so important, and we talk about that a lot more in the next lesson. You have PS, which stands for preliminary stop, and in the accumulation, it's a preliminary support. So that's the low before the climax low. So before the end, it's your most recent low. Selling climax is where the downtrend officially ends and your range starts. Automatic rally is the first bounce after that bottom. Secondary test is when we come back down to the climax level, and this is where we get some clues about the demand in the market. So are the bulls stepping in like they should, or even is there a lack of interest from sellers? You then have an upthrust action, which is essentially testing the upper end of the range that we just formed and usually sweeping it, taking some liquidity, but falling back inside because it's too early for a real breakout. We're still in phase B. You then have a test, and you can have multiple different tests. And the key thing to remember here is that in phase B, it's full of tests. You test the range low, you test the range high. Sometimes you go above. So sometimes you have false breakouts on the upside or the downside. Sometimes you don't. The main thing is you have many, many tests in phase B. Then we have in accumulation what's known as a spring. Generally, this is a false breakout to the downside, but the difference is it happens in phase C. Now, it also doesn't have to break the lows to be valid. And so we can have different types of spring. You can have a TSO, which is a terminal shakeout. This is the one you will all recognize. This is where price comes down to the low, has a really violent move down below it, lots of volume comes in, but price reverses and goes back inside range. Typically what you'll see is a long wick on the chart. This is what's called, the manipulation phase, I guess people will call it. This is the stop hunt. This is where people get trapped. Bear trap on a accumulation. But you can also have a LPS, last point of support. That's where price comes down but fails to break the lows, which indicates strong demand. It's like a rounded bottom. It shows support. So that's also valid because price not going below the lows is also a good sign. And then you can also have a spring test, which is like a combination of a terminal shakeout and a last point of support. Your last point of support comes down, it doesn't take out the low, but it goes more rounded. A spring test also doesn't take out the low, but it moves violently towards the low. It's designed to shake people out before the low. So price moves down really fast, lots of volume. It seems like it's going to break down, but it actually doesn't. Then we have tests, and you have tests, as I said, all the time. But after your spring, you have a specific test to confirm it was a spring. We then have show of strength, SOS. That is when the market is now shifting into an uptrend. And you see a bullish trend move both through the range and above the range. And you notice as price makes higher highs, you can mark them as shows of strength. JAC, jump across the creek. So the creek I mentioned at the very start, which is the range high of your accumulation. Bullish show of strength in phase D is your jump across the creek. LPS, last point of support. These are the higher lows in phase D and E. So the way markets trend up, of course, is you have higher highs and higher lows. So those higher lows that progressively form are LPS. And then you have the BU or BUEC, which is a retest of the breakout. It's called a backup or backup to the edge of the creek. Now in distribution, we have the same shift of control. Okay, so in distribution, the market will shift from bullish to ranging and then to bearish. But it's the same thing. You have two of them, and you want to look out for them. PSY, preliminary supply. Same as preliminary support, just inversed. It's the first attempt to stop the uptrend. It will fail because we go into a buying climax. The next one, BC. So that's the action which stops the uptrend. Then we have AR, which is automatic reaction. Just like the automatic rally, this is the automatic sell-off, the first bearish reaction. As with the AR, automatic rally or automatic reaction, what you want to see typically is that it retraces 75% or more of the previous leg. So from the last low to the final high, so your last swing low to the final high, the buying climax, if you put your fib tool on that and draw it, more than 75% retracement is an early indicator that the trend is not continuing because trend legs should not pull back 75% or more. You then have secondary test. That is basically where the bulls try to push price higher and they fail to do so. Upthrust, much like the test and the spring phase, is a false breakout of the climax level. But what makes it different to a spring and what makes it different to a UTAD, which we'll talk about in a moment, is the upthrust comes in phase B. So it's too early for a breakout. Okay. Then we have a minor show of weakness, MSOW. This is where price loses a key support on a false breakout and it reclaims the range, but it shows us weakness because it shouldn't have lost that if it was actually bullish. But note here the use of the small m to denote minor, because we also have a major one later, which has a capital M, and you'll see why. Minor shows of weakness can also be lower lows in phase D and E. UTAD, upthrust after distribution. This is very common to what everyone will have seen. This is the ultimate trap that you will see when price pushes above the high after pushing a few times. It's a false bullish breakout. It comes back below. This is testing the bull's demand once again and always traps breakout buyers. And that is usually the actual top. We have tests. So then you have a test of the previous UTAD to again check the commitment of buyers. And the tests are the ones that offer the good entries for trades. And then you have a major show of weakness. So this is where you don't just lose a support and then reclaim it. This is where the market starts to trend aggressively downwards after UTAD, and this begins phase D. These are lower lows, and we mark them as a capital M SOW for a major show weakness. Then we have the LPSY, which is the last point of supply, which are the lower highs that we see in phase D and E. So you'll understand and you'll know that everything that occurs in distribution is just an inverse of what occurs in accumulation. Now, this video just serves for you to come back to at any time if you want to hear me explain any one term. That's what this video is for. It should not make sense to you if it's the first time you've watched it, but now, by going through the next lessons, and we apply it to the chart, it will make sense to you. So let's do that right away.